Welcome everyone to another episode of Financial 15. Kevin and I are ready to go. Lots of information today. Today we're tackling the spousal RRSP. What is it? What is the tax advantage? How do you incorporate it into your retirement plan? We'll cover all of that. You want to stick around.
Yes, it's that time of year again. As we talk about, RSP season is upon us. The turn of the calendar happened all the way through to the beginning of March. This is what tends to be on the top of people's minds going forward. And we want to deal with all the RSPs aspects we can. So today we're going to deal with spousal RSPs. Now, if you want videos on this one or any of the other videos we've done on this topic or anything else, please go to our YouTube channel, subscribe, make sure that you get all the information that you can, and we can take a look at how things work here and there. Otherwise, if you want, go to our website at beckerorr.com. Plenty of information there, or like us on Facebook. Again, all these options will give you the access to everything that we've got. But today, as Clint mentioned, we are dealing with spousal RSPs. What are they? How do they work? Are they good for you? Variety of different options. Clint, start us off. What is a spousal RSP? What do we have to look at?
Let's start right at the top there. What is a spousal RSP? We'll go through a few of the basics and then get into some of the nuances. Spousal RSP, the basic concept is that you can contribute to the RSP that's in the name of your spouse or common law partner. That's pretty simple. So I can contribute to an RSP in my wife's name. I'm the one that's doing the contribution, so I get the tax deduction, but the money's in her name. So down the road when she pulls it out, it can be taxed under her name. So you get a bit of income splitting there. Now it uses my RSP room. So the person doing the contribution, it uses their RRSP room. And as we just mentioned, the partner who does the withdrawal down the road, they can claim the income. This works best when there's a gap between the incomes of the spouses, specifically the retirement income between the two spouses. When there's a big gap between the two, this can certainly be beneficial. Now, it can often get confused, Kevin, spousal RSP, regular RSP. Yeah. There is a bit of confusion there. So we created a little table to help make that distinction. Why don't you run us through this?
Yeah, exactly. I mean, a lot of people don't know how these things work. And you mentioned some very important points there that really need to be clarified. So who makes the contribution? Well, again, it's called a spousal RSP. So if one spouse is making the spousal contribution, they are contributing to the opposite spouse. So as we see in this example, Taylor on a personal will contribute to his own, Jerry on a personal will contribute to her own, and Jerry spousal, Taylor would contribute to Jerry spousal. Now, again, what RSP limits are used? That's a very important one. We use the person who's contributing is. That's what it is. So even on the spousal, if Taylor is contributing to Jerry's spousal, we're using Taylor's room, not Jerry's. And again, it's the same sort of thing. If you've contributed, Taylor in that case for the spousal RSP will also get the tax deduction. But when it comes down to the actual ownership, that's where we're talking spousal RSP. If Taylor's contributing to Jerry's spousal, Jerry owns the spousal RSP, even with Taylor contributing. And then who pays the tax at withdrawal? Again, that's the main reason you're doing this, is because you're contributing to the spousal so that Jerry, in this case, Jerry's going to be the one that's going to be claiming the withdrawal when the money's taken out. Sort of a simplified view. Anything else you want to add on those points? Or
no, that is good. That is gives us a good summary. Who puts the money in, which RSP room is going to get used, who claims the tax deduction, and then who pays the tax in the end. And that's what the whole key features there. The idea is one spouse can get the tax deduction, ideally the higher income spouse. And then the lower income spouse can be the one that ultimately pays the tax, right? So that's an advantageous move. You get the break at the higher income, paying the tax at the lower income. That's the whole concept here. That's what we're trying to get through. And that's why people do it. And we'll give you a quick example here. This is looking at a concrete example, looking at the tax brackets for 2022. This is combined Manitoba and federal, the tax brackets. But regardless of where you live in Canada, the concept is the same. So let's say one spouse is at 155,000, so their marginal tax rate's 46.78% there. The other spouse is, say, 50,000, so their marginal tax rate is 33.25%. Well, that's a pretty big gap. If you can even that out, you'll probably save quite a bit of tax. So the idea is you add to a spousal RSP, so there's a lot of money in both spouses' names. Then come retirement, the spouse can take money out of the spousal RSP and start paying the tax. So let's say both of their incomes end up around the 100,000 mark. So they're paying that 37.9% as opposed to having to claim some of the income at the higher rate. So that's the whole concept, kind of splitting the difference, paying the tax at the lower rate. Anything you want to add to that, Kevin?
Yeah, no, and I think that's the general concept that the spousal RSP is for, is that we want to split the income tax down the road. We want to make sure that you're having the higher income person's not paying as much and the lower income person's paying a little bit more. So that evening out, as you've shown in your example here, 46 to 37, that's a 9% spread, whereas 33 to 37, it's only 4. So you can get both on that sort of 37.9 range. You're going to overall pay a lot less tax. So yeah, the spousal RSP is an optional way to try and do this.
Yeah, and the key to note here, if you and your spouse have similar income, ideally in retirement, because that's often when you take money out of the RSP, so that's when the tax kicks in retirement. So in retirement, if the two of you have similar incomes anyway, well, the spousal RSP won't make much of a difference. It's really when there's going to be a gap between one retirement income and the other retirement income. Well, that's where the spousal RSP could be beneficial. And the key here is you have to do the spousal RSP in advance. Like, this isn't something in retirement you can just pull out and use. You have to plan for it. So you have to build it up leading into retirement, so you have that option while you are in retirement. And we'll get through a few key points here, like the one I just mentioned, a few other key points that you have to keep in mind when you're talking spousal RSPs. I'll tee this up for you here, Kevin. Key point number 1, the contribution room.
Yes, and that's a big factor. A lot of people don't realize this. They keep thinking that if the spouse is the one that's getting the benefit of it, I can use my spouse's room. So if your spouse has 60,000 worth of RSP room, well, I can contribute 60 in. No, the person who's making the contribution is the one that has the limit to deal with. So if you have 10,000 worth of contribution room and you put that full 10 in yours, there is no room left to contribute to your spouse's RSP. So that's why you have to seriously think about where the contributions are going. So the big factor is that it is the contributor's RSP room that we're using, not the spouse's, in regard to a spousal RSP. And again, the reason we're doing this, we want to make sure that we're building up room for that spouse. So again, equalization of income coming in after you hit that retirement phase. So it's important to know that you are using the correct room going forward.
Yeah, and another key point here is the 3-year rule. We haven't mentioned it yet, but this is a key factor. You can't just load up a spousal RSP and then a year later take it out and the other spouse pays all the tax. Not the case. We'll go through a quick example. In our example, we're coming back to Taylor and Jerry here. Let's say Taylor made the contributions to the spousal RSP for Jerry for a number of years. You have the example there in 2019 right through to 2022. The typical case, well, Taylor gets the tax deduction, but when Jerry withdraws the money, Jerry would claim the income, Jerry would pay the tax. That's normally how it works. But the 3-year rule says that if you withdraw the money in the same year in which it's contributed or the 2 following years, so that's the 3-year rule, a year of contribution plus the 2 that follow, well, the income then gets attributed back to the contributing spouse. So some jargon there, but in our example, if Taylor's putting money in a spousal RSP for Jerry, let's say you got 2019, 2020, 2021, 2022, and then in 2024 or anytime prior to that, if Jerry takes the money out, well, it could go back and Taylor may actually have to pay the tax. So you could be losing the whole benefit here of the spousal RSP, because then the tax ends up back on Taylor's tax return as opposed to on Jerry's tax return. So you have to be very cautious of that 3-year tax rule. So often as you're leading into retirement, you're building up these spousal RSPs. Well, you stop adding to the spousal RSP a couple of years prior to retirement, so that in retirement, when you start taking the money out, you don't get caught with this 3-year rule. So it's a very important one to remember, that 3-year rule. Another very important item that's came in the last couple of years here, Kevin, that's really changed the whole way how people use spousal RSPs. It's pension splitting.
Yeah, again, I mean, the main rationale, the longest time that the spousal RSP was there was because you wanted to income split with your spouse and you didn't have any of the other options that were available. I mean, whoever had the pension, whoever had all the RSPs, if you were the one spouse that had it and your spouse didn't have anything else, you were going to claim all this money, you were going to pay tax on all of it. And then all of a sudden the rules switched a few years back where they allowed pension income splitting. So all of a sudden your pensions can be split. And again, this is another factor that if you're over the age of 65, you can income split your RSPs. So even if one spouse has all the RSPs, now they can split them. So spousal RSPs have become less relevant going forward for some of that reason. But again, one thing that we should look at in regard to the pension splitting is that 65-year age. So if you and your spouse are planning to both retire in the early 60s and you want to collect full CPP at 65, you're going to need a method to deal with it. So if you have a spousal RSP and an RSP that are together, you can still do that pension splitting sort of aspect in the fact that you can both draw from your RSPs and claim them. So there is still a purpose for the RSP, but pension splitting has been a game changer for how this whole thing works.
Yeah, and pension splitting is a good thing. It's a benefit. It's another
Yes.
tool that you can use to help save tax. It just makes spousal RSPs a little less valuable, is what it comes down to. And we did a whole video on pension splitting. So if you want all the details there, feel free to check out that video. One key item here for pension splitting is the RSP. You have to convert it to a RIF. We won't go through all of that now, but technically the withdrawal comes from a RIF, and then you can split the pension. So our spousal RSPs after 65, really not so valuable because you have this pension splitting. Prior to 65 can still make a lot of sense because it can help you split the income before the pension splitting really kicks in. So this really comes down to a final point here is you need to have a plan. You need to make sure this is going to make sense for you. It's going to be a tool that you can effectively use. It works around the 3-year rule, plus allows you to get some tax benefits. Usually if you want to retire before 65, that's when a spousal RSP would make most sense, and that there's going to be a gap in the retirement incomes between the two spouses. But the whole idea here is you got to make sure it's a fit. You got to have a plan and see if this can actually be a good part of your overall retirement plan. Anything you want to add to that, Kevin?
No, and I think that's the big point to deal with. Again, I mean, it's not like a normal RSP where you can make last minute contributions. You do mention that 3-year rule, and that's very important. So you do need to know years in advance. How do you think you're going to play it? When do you think you're going to retire and all that? I mean, if you're looking to go to 65, maybe this isn't for you. But if you're planning on retiring earlier, spousal RSP may be something that you should really consider, but it's not something you can do last minute. So again, having that plan, making sure it's all updated and ready to go is the big factor to deal with. If you have questions on this or any other of our RSP or pension splitting topics or anything else in the financial vein, please visit us at chatwithclintonandkevin.com. We're more than happy to answer any of the questions that you come across and get back to you as quick as we can. And we do offer all these services that we're talking to you about today. So other than that, I think that's a fairly good structure of how spousal RSPs work and what the benefits are and the positivity for it. Anything else on a closing note for you, Clint?
I think that covers it all. So we'll be back again soon with another video. Until then, everyone stay safe and take care.